Hey guys, this is your host Nitin Binhani and a very warm welcome to my startup podcast channel Jazair Audio, where we share real stories with real learnings.
This week, we're diving into a story that's both a cautionary tale and a powerful lesson for entrepreneurs and business leaders alike. Today, we'll be talking about LogiNext Solutions, a global SaaS logistics startup that, despite its tremendous growth trajectory, now finds itself with dramatic turn of events.
First, the disclaimer: the content of this podcast is based on media reports and is for informational purposes only. We do not verify the accuracy of the information presented, nor make any claims about the startups or individuals mentioned in this podcast.
LogiNext Solutions, founded in 2014 by Carnegie Mellon alumni Dhruval Sanghvi and Manisha Raisinghani, set out to revolutionize delivery automation across key sectors like retail, e-commerce, and food services. Its SaaS-based delivery automation platform had attracted global brands such as KFC, Starbucks, McDonald's, and many more. The startup's rise was rapid, fueled by significant investment. Over the years, it raised a total of $50 million, achieving its peak valuation of $100 million after a $39 million funding round in 2020. This round was led by global heavyweights like Tiger Global and Steadview, signaling strong confidence in its future. With roots in both Mumbai and New Jersey, LogiNext seemed poised for success and soon to be a unicorn. However, in a surprising turn of events, LogiNext has recently liquidated its assets for just $250,000. According to a board resolution on July 8th, reported by the Economic Times, it has sold off its software, hardware, subsidiaries, and all customer and vendor contracts to Delaware-based Liquidation Inc. The liquidation would not yield anything for common stockholders, as it could barely cover the preferred stockholders' liquidation preference. The dissolution of LogiNext's assets signals a challenging period for the SaaS sector, which saw explosive growth during the COVID-19 pandemic. But as the world began to reopen, the logistics automation sector faced significant headwinds, similar to the edtech sector. LogiNext's rapid rise during the pandemic was met with an equally steep decline later on. Despite returning $8 to $9 million to its investors and setting aside $2 million as working capital, the company couldn't escape the post-pandemic pressures on the logistics SaaS industry. LogiNext's struggles didn't just stem from external factors. Internal challenges, too, played a significant role in its downfall. In 2021, co-founder and CTO Manisha Raisinghani left the company to launch SiftHub, an AI-driven platform for enterprise sales. Leadership changes like this can be incredibly disruptive, especially in a company's formative years. The asset sale was supported by key stakeholders, including Tiger Global, which held a 50% stake, and co-founder Dhruval Sanghvi. However, Raisinghani opposed the move, believing the company could secure a better deal. The transaction's appeal lay in its ability to transfer liabilities to the acquiring entity, allowing investors to recoup some of their capital. Anything better than nothing. Despite these developments, Sanghvi has refuted claims of layoffs or operational downturns, asserting that LogiNext continues to serve its global client base, particularly in the US. Nonetheless, the company's struggles reflect broader industry trends, as the logistics SaaS sector grapples with post-pandemic challenges and internal upheavals. Key learnings from the LogiNext Journey. LogiNext's story highlights the critical need for SaaS companies to remain adaptable in rapidly changing market conditions. It highlights that market timing and sector-specific challenges are vital considerations for startups. The inability to pivot effectively post-pandemic has devastated many startups across sectors that once grew exorbitantly. This proves that strong initial performance can be easily undermined by external factors that are beyond the company's control. Rapid growth can be a double-edged sword. While LogiNext scaled quickly and attracted significant investment, sustaining that scale of growth proved challenging. Plus, the departure of key executives hit the final nail. Leadership changes can significantly impact a company's trajectory. It proves a need for effective succession planning in order to avoid disruption in operations and growth. LogiNext's sale, despite opposition from Raisinghani, demonstrates the complex dynamics that can arise between founders and investors when the company faces difficulties.
And with this, we have reached at the end of this podcast. Thanks for your valuable time and please like, comment and share.